Gold is absolutely smashing records right now. But let's be real. How do you get paid from an asset that famously pays you, well, nothing? Today, we're going to dive into its incredible rally and a pretty unique way some investors are trying to turn this shiny metal into a serious income stream. All right, here's the game plan. We'll kick things off with why gold is soaring. Then we'll get into this special class of funds that are designed to squeeze cash out of it. We're going to break down how they work, the major trade-offs, and you know there are trade-offs, and what it all could mean for you. So, first things first, let's set the stage. Gold isn't just having a good year. It's on a truly historic run. But what in the world is fueling this fire? Let's take a look. Just look at that number. Wow. On January 27th of this year, gold didn't just break records, it shattered them, closing above $5,000 an ounce for the very first time. I mean, that's not just a small hop, it's a massive, massive milestone. You know, this isn't happening in a vacuum. It's really a perfect storm of factors. You've got central banks around the world buying up gold like crazy. The US dollar has been getting weaker, which makes gold cheaper and more attractive for international buyers. And on top of all that, with all the global uncertainty, investors are just flocking back to gold as that classic, safe place to park their money. Okay, so with gold at these unbelievable highs, a whole new question is starting to pop up. How do you actually generate cash flow from an asset that, by its very nature, pays you nothing just to hold it? And that right there is the classic dilemma for anyone who's ever invested in gold. If you own a gold bar, or even a standard gold ETF, your only way to make money is if the price goes up. That's it. There are no dividends, no interest. You don't get paid to wait. But then, you see this. A whole new breed of funds has popped up, offering these truly mind-boggling dividend yields. So while a traditional ETF like GLD pays you basically zero, these new income funds like GDXY and IAUI are boasting yields from over 12% to an absolutely eye-watering 51%. The goal here is to turn a dead asset into an income-generating machine. So you're probably asking, how on earth is that even possible? Where does all that cash come from? Well, let's pull back the curtain and see the engine that powers these things. It all comes down to a strategy called option writing. Let me break it down. In simple terms, these funds are making a deal. They collect cash payments right now, today. And in exchange for that cash, they promise to sell their gold assets later if the price rises above a certain level. So they're basically getting paid now by selling off a piece of their potential future winnings. And this shows you the cycle perfectly. It's a simple four-step process. The fund holds gold assets, it then sells these call options against them and collects cash, called premiums. And then that cash gets paid out to investors like you as distributions. It's a constant cycle of trading future growth for income today. I know, this all sounds pretty amazing, right? Getting huge income checks from gold. But as you've probably guessed, there is a massive catch. This high yield comes at a really significant cost, and it's a trade-off you absolutely have to understand. Okay, the proof is right here in this chart. The income fund GDXY has had a total return of 66% since it launched. Hey, not bad. But look at the traditional gold miners ETF it's based on, GDX. It returned over 132% in the same exact time. By selling off those big potential gains, the income fund's total return is less than half of what you would have made just holding the regular fund. And it's the exact same story with the other fund, IAUI. It delivered a 32% total return, while the standard gold ETF, GLD, is up over 48%. The pattern is crystal clear. You are giving up a big chunk of potential growth in exchange for that income stream. Now, to really understand the risk here, let's look at what can happen when the music stops. For this, we're going to look at a similar fund, MSTY, which was tied to that massive Bitcoin rally back in 2025. Think of this as a cautionary tale. So check this out. While Bitcoin was going to the moon, MSTY delivered an insane 239% return. But the second that momentum reversed, the fund just cratered. The share price collapsed by over 76%, wiping out all of those gains and then a whole lot more. And this is the critical risk, you guys. These strategies cap your upside, but they give you full 100% exposure to the downside. All right, let's try to make this a little more real. We've talked about the big yields, we've talked about the big risks. So what could this income actually look like if you put it all together in a hypothetical portfolio? Let's just imagine for a second An investor decides to put $100,000 into these funds, and they split it right down the middle, 50 grand into Judy XY and 50 grand into IUI. Well, based on their current yields, that hypothetical $100,000 investment could, in theory, generate around $31,850 in annual income. I mean, that is an incredible amount of cash flow from a six-figure portfolio. Okay, I have to stop here and say this as clearly as I possibly can. That is a very powerful number, but it comes with equally powerful risks. This is just an illustration to explain a concept. It is absolutely not investment advice. Remember, high yield always equals high risk, always. So let's be crystal clear on what those risks are. First, your initial investment, the share price of the fund, can actually shrink over time, even while it's paying you. Second, that juicy income is not guaranteed. If gold stalls or volatility drops, so will your payments. And most importantly, like we saw with MSTY, you are not protected if gold prices fall. The strategy limits your gains, but it does not limit your potential losses. So, after all that, it really comes down to one simple question. What are you trying to do as an investor? What's your goal? Your answer is going to tell you which of these strategies, if any, might make sense for you. And this table just lays it out perfectly. If you are super bullish on gold and you want to capture every last bit of upside, then traditional funds like GDX and GLD are your play, but you get zero income. On the other hand, if you need cash in your pocket now, and maybe you think the big rally is starting to run out of steam, then the income funds start to look interesting. But you have to be okay with leaving potentially big gains on the table. This quote from one of our sources just hits the nail on the head. It really boils down the entire strategic choice you're making. Choosing the income fund is basically a bet that gold's best days, for now, are already in the rearview mirror. So in the end, the choice between income now versus potential growth later, it all boils down to this one question. Are you investing for the cash flow to spend along the journey, or are you investing for the biggest possible pot of gold at your final destination? Your answer to that tells you everything you need to know.